So what the focus is continue to offset negative yield without losing daily access to your operating balances.
Hello and welcome to the Bankers Masterclass series on rethinking liquidity and investment in association with Deutsche Bank. My name is Brian Caplen, editor of The Banker, and with me is Vanessa Manning, Global Head of Investment and Liquidity for Deutsche Bank Transaction Banking. And in this first chapter, we'll be discussing the shifting liquidity landscape. So Vanessa, a huge amount has changed in liquidity over the past few years, hasn't it? So what does it mean for anybody playing in the liquidity space, banks and corporates and so forth?
I think there's three main areas that the banks are focused on. The first being the regulatory environment, the second being the interest rate environment, and the third is emerging technologies and changes to clearing and settlement architectures.
Okay, so I mean we've seen an awful lot happen with the regulation, including the advent of open banking, for example, which brought a lot of new players into the scene. What's that done for instant banking?
Well, in terms of open banking and new emerging technologies, what you're seeing the banks focused on, and Deutsche also, is focused on providing value-add services, ancillary related services, not just being the payments provider. So what am I talking about is really using third-party fintechs or taking ownership of certain fintechs to provide value-add services, whether those are risk and analytics, or whether those are identity services, whether those are dashboarding services, to provide more information, more choice for our underlying customers.
So clients are being very demanding indeed, it seems.
Absolutely, but I think that is one of the things that the regulatory environment has enabled. For example, through PSD2, and the creation of that level playing field, it has forced the banks to develop their API strategies, to be more open in their architecture, and therefore be able to provide services from a proprietary and a partnered perspective that our customers are asking. The advantage is that it just takes a little bit less time to do so under an open banking environment using fintechs than it did in the past.
Now what we've seen in the retail area obviously is a move to faster payments for low value payments. I mean, how is that impacting on the corporate space? I mean, how have companies responded to that?
If you take, for example, the UK for faster payments, the thresholds are very low. They're very suitable for immediate retail, person-to-person exchanges. But the theory of faster payments is something now that is very well established and understood by our corporate and institutional customers. For example, in SEPA Instant, for example, corporates are doing two or three things. Firstly, they're consolidating the number of accounts that they hold with their banking to have that transparency, cost efficiency and quicker liquidity.
So they're simplifying their business.
Simplifying their business. They are looking for cost efficiency. You see an increase in the number of corporates moving their high-value RTGS flow into SEPA Instant flow because it's same-day value and it is cheaper and quicker, and you have standard ISO XML formats. Okay.
So it's changed the way corporates have reacted quite a lot. I mean, are there other things that are coming along on the horizon that are going to change it even more?
I think negative interest, changing interest rate environments are what are keeping both institutional and corporate treasurers very busy. So
because we had a period of very long low interest rates.
Absolutely. So in the backdrop of slowly increasing dollar, slowly increasing sterling, a negative euro for the next 18 months, it's a real challenge for corporates and institutional customers. So what the focus is continue to offset negative yield without losing daily access to your operating balances. In addition, providing solutions for surplus cash that are not operating. So if you recall, under Basel implementation, operating balances are provide the most value and systemic stable core funding to banks, which is why all banks have a strong dialogue with customers around the nature, quality of their operating balances.
Okay, Vanessa, we'll come back and talk about the regulation in just a second. Thank you.